Most people think making money in the market means picking a direction. The stock goes up, you win. The stock goes down, you lose. But what if the most profitable trade is the one where the stock barely moves at all? That's the Iron Condor, a strategy designed to profit from boredom, from sideways, from the market doing absolutely nothing. And in a market that spends more time going sideways than most people realize, that's a powerful edge. An Iron Condor is a combination of two credit spreads, one on each side of the current price. On the lower side, you sell a bull put spread. You're saying, I don't think the stock will drop below this level. On the upper side, you sell a bear call spread. You're saying, I don't think the stock will rise above this level. Together, these two spreads create a range, a channel. As long as the stock stays within that channel by expiration, you keep the full premium from both sides. If you've already watched the credit spreads video in this series, you're halfway there. An Iron Condor is simply both spreads, put credit spread and call credit spread, on the same stock at the same time. Let's use a real example. A stock is trading at $100. You believe it's going to stay between roughly $90 and $110 over the next 30 days. Here's the trade. On the put side, you sell the $92 put and buy the $87 put. That's a $5 wide bull put spread. You collect $1.20 in net credit. On the call side, you sell the $108 call and buy the $113 call. That's a $5 wide bear call spread. You collect $1 in net credit. Your total credit, $2 to $20 per share, or $220 per contract. Your maximum profit is that $220. If the stock stays between $92 and $108 at expiration, both spreads expire worthless, and every dollar of premium is yours. Your maximum loss, the width of one spread minus the total credit. That's 5 minus $2.20, which equals $2.80 per share, or $280. Your break-even points are $89.80 on the downside and $110.20 on the upside. The stock has an $18 window, 18% of its value, where you're profitable. Those are solid odds. Three forces work in your favor with Iron Condors. First, time decay. You sold options on both sides. Every day that passes, those options lose value due to theta. And since you're the seller, that decay is money flowing into your pocket. Second, implied volatility contraction. Iron Condors are a short volatility trade. If you enter when implied volatility is elevated, during uncertainty, before an event, and volatility contracts afterward, both sides of your Condor lose value faster. You can often close the trade at a profit well before expiration. Probability. When you set your short strikes at low deltas, around 0.15 to 0.20, you're giving yourself a roughly 70 to 80% probability that the stock stays within your range. The market goes sideways more than most people think. Iron Condors are built for that reality. Iron Condors are ideal in specific market conditions. High implied volatility rank. When IV is elevated relative to its own history, an IV rank above 30 or 40, the premiums you collect are richer, and there's a higher likelihood that volatility will contract in your favor. Range-bound markets. If the broader market or the specific stock has been chopping sideways without a strong trend, Iron Condors thrive. Trending markets are trickier because one side of the condor is likely to be tested. After events, sometimes the best Iron Condors are opened right after a binary event, like earnings, when volatility is still elevated, but the uncertainty is resolved. The IV crush that follows can make these trades profitable quickly. Low-drama stocks. Large stable companies and broad market ETFs like SPQQQ are classic Iron Condor underlyings. They're liquid, they have tight option spreads, and they tend to move in a more measured way. Entry is only the beginning. Here's how you manage an Iron Condor. Profit target. Close at 50% of maximum credit. If you collected two 20s, look to buy back the entire Condor for $1.10 or less. Don't get greedy trying to capture that last bit of premium. It's not worth the risk as expiration approaches and gamma increases. Time-based exit. If you haven't hit your profit target by about 21 days to expiration, consider closing the trade. The closer you get to expiration, the more sensitive the position becomes to sudden moves. One side tested. If the stock moves toward one of your short strikes, you have decisions to make. You can close the tested side at a loss and let the other side expire for a profit. You can roll the tested side out to a later expiration for additional credit. Or you can close the entire Condor and move on. The worst move is to do nothing and hope. Always have a plan. Adjustment by rolling the untested side. If the stock has moved significantly toward your put strikes, but isn't threatening them yet, you can roll the call side closer to the current price to collect additional credit. This increases your total premium and widens your overall profit range. Just be careful not to move it too close. Iron condors should be sized conservatively. Your maximum risk on any single iron condor should be no more than 2 to 5% of your account. Since the max loss is defined, spread width minus credit, you can calculate exactly how many contracts to trade. Example, if your account is $50,000 and you want to risk no more than 2%, that's $1,000, and your max loss per contract is $280, you could trade 3 contracts. That puts $840 at risk, well within your limit. Running iron condors across multiple underlyings, different sectors, different expirations, further diversifies your risk. If one condor gets tested, the others may still be profitable. Here's something nobody talks about enough. Iron condors train you to be comfortable with doing nothing. In a world where traders feel like they need to be active, the iron condor rewards patience. You enter the trade, set your management rules, and wait. Most of the time, the trade is boring. The stock wiggles around inside your range. Nothing happens. And then, 30 days later, both sides expire worthless, and you quietly collect your premium. That boredom is the point. That boredom is the edge. An iron condor is a bull put spread and a bear call spread on the same stock, creating a profit zone. You collect premium from both sides. Time decay and volatility contraction work in your favor. Your risk is defined, your profit is capped, and the probability is on your side. Use iron condors in high IV range-bound environments. Manage at 50% profit, size conservatively, and embrace the quiet. This is what trading with structure looks like. Subscribe. More strategies are coming. We're building a complete playbook here. Calm, methodical, and built to last. See you in the next one.